Welcome to the FDIC's Money Smart for Adults. This module helps you track and understand your income, money coming in, and your expenses, money going out. This module also discusses the different types of income and the ways we receive income, shows you how to read a pay stub, shares a tool for tracking income, and provides information and tools for tracking and managing expenses. In Section 1, we will discuss income. We will discuss the different types of income, ways to receive income, how to read and understand your pay statement or pay stub, and how to keep track of your income. Key takeaway: understand your income. This is the first step to using it to meet your needs. Let's talk about income. What is income? Income is the money that you receive. There can be different kinds of income. Earned income. This is what you earn by working, whether it is wages from a job, tips, contractual work, or what you make through self-employment. Income from assets or investments. Assets are things that you own. For example, asset is an interest that a financial institution pays you on money that you keep in your account. Or maybe someone pays you to borrow your lawnmower or your pickup truck. Some people also earn money from stocks, bonds, a business, or real estate. Public benefits or entitlements that pay money. This includes temporary assistance for needy families, TANF, Social Security Disability Services, SSDI, and Supplemental Security Insurance, SSI. It is important to fully understand any benefits that you may receive. That way you know what income to expect in the future. And consider reviewing the program rules that you need to follow to keep the benefits. To learn more, use the contact information on your most written communication from the program, or talk with your benefits counselor or other trusted person who helps you with your benefits and finances. Other benefits or entitlements. This income may make it possible for you to buy or receive food or use public transportation. These are things that you would have spent money on, so even if they are not paid in cash, benefits can be considered a form of income. They free up your money to spend on other things. The following is not a comprehensive list, but it gives you some examples. Child care subsidies, transit subsidies, Supplemental Nutrition Assistance Program, or SNAP, sometimes called food stamps, Supplemental Nutrition Program for Women, Infants, and Children, or WIC, housing assistance, or utility assistance. Other income, such as gifts, child support, and alimony. The income you take home is generally less than the earned income you make from working. Gross income is your total income without any deductions. Your net income is the gross income minus deductions such as Social Security, income taxes, health insurance, and other benefits deducted by your employer. Net income is what you have to save, share, and spend. Net income is also called your take-home pay. If you owe money, your creditors can sometimes directly take part of your income to cover your debt. This is called garnishment, and it generally happens as a result of a court order. Through wage garnishment, part of your paycheck can be withheld to repay a debt you owe. These are things such as student loans or child support. Through account garnishment, money in an account you have at a financial institution can be taken to repay a debt you owe. Also, all or part of some government payments can be taken if you have a seriously delinquent debt owed to the federal government, such as unpaid taxes, federal student loans, or if you owe court-ordered child support. To learn more, go to usa.gov and search for Treasury Offset. There are pros and cons to each way of receiving pay. Cash is generally accepted for purchases that you make in person and is available for use right away. However, it could be lost or stolen, and it does not have federal deposit insurance unless you deposit it into an insured account. Paper checks can be deposited into a checking or savings account that offers a federal deposit insurance and other benefits. You could also load it onto a prepaid card. However, if you deposit a paper check in an account at a financial institution or onto a prepaid card, you may not be able to use the money right away. Paper checks can also be lost or stolen before you deposit or cash them. Direct deposit is often the fastest and safest way to receive your pay. Funds are usually available immediately, and you do not have to make a trip to your financial institution. However, there can be fees associated with the account, although many financial institutions offer safe accounts that have no fees. Payroll cards, also called pay cards, are cards that your employer loads with the amount of your net pay. This is safer and more secure than carrying cash or checks, and the payroll card has full consumer protection for funds taken by error or theft. However, there may be fees associated with the card, such as to use the card or if you don't use the card frequently. Electronic Benefits Transfer, EBT cards, are cards which some programs use to pay for benefits. EBT cards are loaded automatically with the benefit payments. They are safer and more secure than carrying cash or checks, and depending on the state, you may be able to track your spending online and see your current balance on receipts when you use the card. However, you likely do not have a choice. If a benefit you are receiving is paid on an EBT card, then that is what you'll receive. Also, all merchants do not accept EBT cards. Now that we've talked about different ways to be paid, let's discuss your pay statement. When you work, you will receive a pay statement. You must read it carefully to learn what information is on it. It will help you monitor it accurately and understand how the amount of money you earn is not the same as the amount of money you will receive. Your pay statement may also be called a pay stub, a leave and earnings statement, an earnings and leave statement, an LES, an ELS, a pay slip, a pay advice, or something else. No matter what name your employer uses, your employer will generally provide you with information about the details that support the amount of income they are paying you each pay period. Depending on your employer, you may receive the information on paper or you may receive it electronically. If you have questions about your pay statement, please partner with your employer. Some employers have payroll and human resources departments that can help you. Pay statements can look complicated, and they can even be a little intimidating. But once you learn the basics about the information they generally contain, they will be a lot easier to understand. There are many formats for pay statements, so yours probably won't look exactly like the example we're looking at today. Looking at the example will give you practice finding pieces of information that typical pay statements contain. This includes personal information, your name and address, for example. The pay period, the time period you're being paid for. It could be a week, 2 weeks, a month, or something else. For example, the pay period could be December 1st through December 14th. Pay date. This is the date that you will receive your net pay. There's often a delay between the end of the pay period and the pay date. It could be every Friday, the 1st and 15th of every month, or perhaps every other Tuesday. Gross pay. This is how much money you earn during the pay period. The pay statement will also show your year-to-date gross pay from the employer. Deductions. These are the amounts taken out of your gross pay for Social Security, Medicare, federal and state income taxes, elective deductions such as health insurance, retirement account contributions, and others. The pay statement may also show the year-to-date deductions made by this employer. Net pay. This is the amount of money you will receive after all deductions are taken out of your gross pay. This is your take-home pay. Employer contributions. This is the amount your employer paid for benefits such as health insurance. The pay statement may also show your year-to-date employer contributions. Balances for your personal time off, vacation, and/or sick leave. These may also be included on your pay statement. Pay statements usually use many abbreviations for types of pay and deductions. You can get help from your employer, the Human Resources Department, or payroll person to understand any abbreviations that are not clear to you. The deductions portion of your pay statement will have several items which fall into two major categories: required deductions and elective or voluntary deductions. Let's look at the required deductions first. Employers are usually required to take taxes out of your pay and send them to the appropriate agency. Taxes include amounts required under the Federal Insurance Contributions Act, often called FICA. These taxes are set by law at a fixed percentage of your wages. FICA taxes include two items: Social Security and Medicare. The Social Security deduction is sometimes labeled OASDI or just SS. The acronym OASDI reflects that your Social Security contributions help pay for old age, survivors, and disability insurance. The Medicare deduction is sometimes labeled FICA Med or just Med. Your Medicare contributions help pay for Medicare. That is a health insurance program for people 65 or older, people under 65 with certain disabilities, and people of all ages with end-stage renal disease. Taxes also include money that employers withhold for federal income taxes, state income taxes for states that have income taxes, and local income taxes if required in your community. There are also elective or voluntary deductions. This refers to the money that you have decided to have taken out of your pay. For example, this could include health insurance premiums, union dues, charitable contributions, and/or other direct deposits to a savings account. Retirement plan contributions could be required deductions or voluntary deductions. Ask your employer if you have any questions about how to read your pay statement and what items were taken out of your gross pay. Before an employer withholds federal, state, or local income taxes from your gross pay, they will likely ask you to complete forms so they know how much to withhold. You will complete a form for federal income tax purposes and possibly a similar form for your state or community. You complete these forms and give them to your employer when you start a job. You may be doing this on paper or electronically. You can also give your employer new forms anytime you want to adjust how much it withholds from your pay going forward. Consider completing these new forms each year and when your personal or financial situation changes. For federal income tax purposes, you complete the Internal Revenue Service, IRS, Form W-4, Employees Withholding Certificate. You can indicate you want additional federal income tax withheld above what would be withheld based on your salary and tax filing status, or you can reduce your withholding. You can also indicate if you are exempt from withholding. If you indicate you want additional federal income tax withheld, your take-home pay is likely to be lower, but at tax time you might owe no additional money for taxes or receive a refund. If you indicate you would like to reduce your withholding, your take-home pay is likely to be higher, but at tax time you might owe money for taxes. Be careful not to have too little withheld. If you don't pay enough tax throughout the year, you may have to pay a penalty for underpayment of estimated tax. Form W-4 includes both general and specific instructions to help you complete the form. Ask your employer for help if you do not understand something on the form. You can also view the Form W-4 by visiting irs.gov and searching for W-4. Form W-4 is different from Form W-2. Employers are required to provide employees with a Form W-2 by January 31st for the prior year. Included on the W-2 is the amount of money you earned from the employer the previous year and the taxes that were withheld. You can view Form W-2 by visiting irs.gov and searching for W-2. Some people have more than one job. They may have a full-time job and a part-time job, 2 or more part-time jobs, or even 2 or more full-time jobs. Some people may have a main job and then work various side jobs. They may call them hobbies, gigs, freelance work, side hustles, or something else. You may have even heard of the term gig economy. Others may not have a main job. They may work multiple side jobs depending on what work is available. No matter what they are called, these jobs may or may not be steady and require careful planning. If you work in this way, be sure you understand how you are being paid. You can ask the employer if you are considered a W-2 employee or a 1099 employee. If you receive a Form W-2, the employer considers you to be an employee. If you receive a Form 1099 miscellaneous, the employer considers you to be self-employed or a contractor. You can view the Form 1099 miscellaneous by visiting irs.gov and searching for 1099 MISC. It is helpful to know if and when you will get a regular paycheck or pay statement. There may be weeks or months between the time you work and are paid. You are responsible for paying taxes yourself periodically, such as quarterly if the employers don't withhold taxes from your pay or if you are self-employed. Making these tax payments on time is important for avoiding penalties. And also, you make sure that you are not surprised at tax time about what taxes you owe. You may need to give more thought into how you are putting money aside for the future, including for retirement. It is important to keep accurate records about your jobs. To make sure that you are paid the amounts you are owed, keep records of your time and the work completed. Also keep record of what amounts you have earned from which employer and whether taxes were withheld. How much income you receive and where it comes from is important. Knowing how regular the income is also important. Regular income refers to income that you can expect to receive every week, every other week, twice a month, every month, or on some other regular schedule. Regular paychecks and Social Security Disability Insurance, SSDI benefits, are examples of regular income. There is also unpredictable income. This is income that varies in the amount and/or timing. Pay from hourly work may be unpredictable if your hours vary from week to week. Here's another example. Some people may only receive child or spousal support payments sporadically and in varying amounts, even though they are supposed to be paid regularly. Seasonal income may be predictable, but it only comes at particular times of the year. Perhaps you always receive money from a friend or family member around the holidays, or you may sell crafts at a fall festival in your community, or be employed as a package delivery driver during the winter holidays. You may also have one-time income that you only get once. An example is a lump sum amount a person might get from their individual Indian money, IIM account when they turn 18. Another example is pay you receive from working one-time jobs, such as helping people move. Keeping in mind whether each source of income is regular, unpredictable, seasonal, or one-time can also help how you will save, share, and spend it. Remember the key takeaway from this section. Understand your income. That is the first step to using it to meet your needs. Section 2 is about expenses. We will discuss the different types of expenses and ways to manage expenses. The key takeaway from this section is understanding your expenses. That will help you decide how to save, share, and spend your income. There are many different things that people do with money, and thinking about your expenses can be stressful, especially if you are worried about making ends meet. Understanding where your money is going can help empower you to make choices and changes. In the long run, that can help reduce stress about expenses. It can be useful to think about how you can use your money in 3 different ways: saving it, sharing it, or spending it. Saving it. You can save your money to build an emergency savings fund to help you in case of a major reduction in income, such as job loss, or to pay for a major unexpected expense. You can also save money for short-term goals, like back-to-school expenses, or long-term goals like retirement. Sharing it. You can share your money with friends, family, charities, or others. Spending it. You can spend your money now to pay for basic living expenses like food, housing, utilities, and debts you owe, and on other things that you need or want. In Money Smart for Adults, we use the term expenses to include all 3 of these ways to use money. It is sometimes helpful to think about your expenses in 3 different ways: needs, wants, and obligations. Needs. These are the things that you must have to live. Wants. These are the things you desire and can live without. Obligations. These are debts you owe because you borrowed money, such as a car loan or a mortgage. You made another type of agreement to pay them, such as rent, or you were ordered to pay them, such as child support. People can consider needs and wants differently. For one person, a smartphone might be a want. For another person, perhaps someone with a disability, they might need the apps on their smartphone to work or live independently. For that person, a smartphone is a need. Asking yourself if you are using your money for a need, a want, or an obligation can help you consider how you want to use your money. It can sometimes be hard to determine if something is truly a need, or maybe it's a want that you wish was a need. Sometimes you have to make some very difficult choices. Once you've identified some items as needs, you can think about less expensive ways to meet those needs. Once you've identified some items as wants, you can think about whether you want to use your money for those items, or if you want to use your money for other items. Once you have identified your items as obligations, you can think about whether you can negotiate payment plans or other arrangements if you cannot make your payments on time every time they are due. For example, people may fall behind on their child support payments. One option might be that they work with the Child Support Enforcement Authority to set up a payment plan they can reasonably achieve. For people who receive public benefits, resort or asset limits may also factor into your decisions on how you use your money. Resource or asset limits tell you how much money and property you can have and still receive the full benefit. These vary for different public benefit programs. If you build up too much in savings, your benefit could be eliminated or reduced. It is helpful to learn about the resource and asset limits from your public benefit administrator or its website. There are programs and products that allow people to save money and not jeopardize their eligibility for benefits. ABLE accounts, which are savings accounts for people with disabilities, are an example. If you receive public benefits through a program with asset limits, monitor how your spending and saving affects what the program counts as an asset. Using income to pay down debt or pay a bill early is one way to use income that would otherwise put you over the asset limit. Use income in productive ways that avoid exceeding the resource and asset limits. Tracking your expenses helps you understand if you are using your money in line with your values and your goals. Tracking your expenses may also uncover where you can make changes, perhaps decrease spending so you can save or share more of your income. Tracking expenses also has another unexpected benefit. When you track your expenses, you usually spend less money. Managing your expenses so you can make payments in advance of their due dates helps you avoid late fees, interest on unpaid balances, negative credit report entries, loss of services, and any additional charges associated with the loss of services, such as higher fees to restart services. We will look at a monthly payment calendar as a tool to managing your expenses. There can be different ways to pay your bills, including in person, by mail, electronically, or perhaps using a mobile app. You may be able to pay in person using cash, a money order, check, debit card, or credit card. Some bills cannot be paid in person. Some people like the assurance of paying bills in person. In person, you can usually use any form of payment. If using cash, make sure you get a receipt or some proof of payment. You can pay by mail using a check or a money order. When paying bills by mail, don't forget the time for the payment to arrive. Checks are forms you complete that instruct your financial institution to take an amount of money that you specify out of your checking account and pay it to the person or organization you name on the check. You will need to make sure you have enough money in the account to cover the check. With a money order, you give the amount of money you want to pay to someone, plus a fee, to a bank, store, or the U.S. Postal Service, and they issue you a money order that looks like a check that you can use to make a payment. You can pay electronically. These payments may be one time, or you may be able to schedule these payments to be made automatically on a regular schedule. There are several ways to set up electronic payments. For example, you may be able to set up payments through your account at a financial institution using their bill pay service, set up payments through your credit card website, or set up payments directly through the entity you owe money to, giving them your bank account number, your debit card number, or your credit card number. You can also use a separate bill paying service. When you pay electronically, you're either giving your financial institution permission to pay the bill by taking funds from your account, or you are giving the company permission to pay the bill through your credit card or bank account. For example, you may allow a utility company to withdraw money from your bank account or charge your credit card to pay your utility bill every month when it is due. Or you may give your financial institution or online bill payment service information about where to make the payment, and they send the payment electronically based on your instructions. Make sure you have enough money in your account to cover the payments or enough credit available on your credit card. Paying electronically usually provides a record of payments, and it reduces the chances of being late or missing payments. However, you still need to be very careful about safety and security. Only pay bills through trusted services. You can also use a mobile app, which is another way to access online bill payment or set up an automatic or one-time payment. Be sure you know what fees you could be charged, depending on how you decide to pay your bills. No matter how you pay the bills, you may want to use a monthly payment calendar on paper or a mobile app to keep track of your bills and how you pay them. If you use the monthly payment calendar, write down when you need to mail, send electronically, or pay an expense in person. This will be before the actual due date. If you plan to pay your bill by mail, enter the expense as due on your monthly payment calendar several days before it is actually due to allow for mail time. The person or business you owe money to must receive your payment by the due date. Receipt by the due date is what counts, not the postmark or when you mail the payment. If you plan to pay your bill in person or using an automatic payment online billing payment service or mobile app, enter the expense as due 2 to 3 days before it is actually due to allow for processing time. Sometimes you can pay bills online, in person, or with mobile app on the same day they are due without incurring a late penalty. Remember the key takeaway from this section. Understand your expenses. That will help you decide how to save, share, and spend your income. This concludes Module 3. Remember the key takeaways. Number 1, income. Understand your income. That is the first step to using it to meet your needs. And number 2, expenses. Understand your expenses. That will help you decide how to save, share, and spend your income. You are more likely to take action if you commit to taking action now. Consider writing down what you intend to do because of what was covered during this training session. Take a few minutes now to answer the questions under Take Action on page 24 of your participant guide. What will I do? How will I do it? And will I share my plans with anyone? If so, who? Thank you for attending this training. Please complete the quiz at the end of the video.